I am Kenji Akimoto. Thank you very much for joining us today despite your busy schedule. Now I'll explain our financial results based on the materials at hand. First, please turn to page 4. Here you will see the financial highlights for the period under review. The overview for the 12th fiscal period ended April 30th, 2019 is shown in the statement of profit and loss on the left. Please look at column B. Operating revenue was 5,924,000,000 yen, and the profit was 2,878,000,000 yen, resulting in distribution per unit being set at 12,974 yen. Looking at the other indicators, the NOI yield was 6.5%. With regard to the NOI yield, we do not show the performance relative to forecasts, because we acquired properties during the period. If we were to assume that there had been a full period of contribution to profit, we believe that the NOI yield would have been more or less at the same level as forecast. LTV came in at 35.8%. Please look at the right of the page. With regard to the breakdown of operating revenue, fixed rents accounted for 64.7% of the total. Also, on March 29, 2019, during the period under review, we acquired 3 new properties, resulting in an increase versus forecasts of about 1 month's worth of fixed rents, or 31 million yen. In the same way, the main factor behind the increase in operating expenses relative to forecasts was the depreciation on the properties acquired during the period. As for distributions, these were 56 yen higher than forecast. The breakdown of the change is as shown here, but the 79 yen decline in non-operating profit and loss was caused mainly by costs associated with borrowings for the properties acquired during the period. The increase in extraordinary income and losses of 40 yen represents the difference between the insurance paid out in relation to the damage to the Hyatt Regency Osaka caused by Typhoon Jebi and the cost of the damage. Now please look at page 5. This shows the trend in the asset size over time, and as you can see, we acquired 3 new assets in March 2019, pushing up the asset size to 155,600,000,000 yen. The asset size is now more than 10 times its value when we were listed 6 years ago. Next, please look at the change in distributions shown in the lower part of the page. Due to a combination of sustained external growth and internal growth achieved through favorable management results, distributions have increased steadily over time. By the 12th fiscal period, distributions had increased to approximately twice the level of the 2nd fiscal period, shortly after listing. So far, I think it is fair to say that we have achieved steady increases in unit holder value. Next, we shall turn to page 6. Now I will give an explanation of each of the 3 recently acquired properties. First, Hotel Nirakanai Iriomotejima. Even among the Yaeyama Islands, Iriomotejima is called Japan's last hidden paradise. This resort hotel is set amongst the jungle that blankets 90% of this island, which is surrounded by coral-filled sea. These facilities allow guests to enjoy an exotic resort stay, surrounded by totally wild nature, where unique fauna and flora still flourish, such as the Iriomote cat. As shown in the right center of the page, between October 2011 and March 2016, this property was operated by Hoshino Resorts Group. After the Hoshino Resorts Group started operations, results were satisfactory, as shown in the graph on the top right. However, the owner wanted to manage the property themselves, which was partly why the Hoshino Resorts Group withdrew from operations in March 2016. With this background in mind, when the Hoshino Resorts REIT acquired the property, it was decided that Hoshino Resorts Group would be in charge of operations. Moreover, a rebranding is scheduled to begin in October 2019. An overview of the property is shown in the table at the bottom right. There are 140 guest rooms in total, and Hoshino Resorts Group is to be the operator. The acquisition price was 3,650 million yen. The appraisal NOI yield is 6.9%, and the yield after depreciation is 4.9%. Please turn to page 7. This is Kai Alps. We provided an explanation of this property at the previous financial results briefing session. This time I would like to give a brief review of the Kai brand. The pattern of operations for Kai Hot Spring Ryokans has already been established, and Hoshino Resorts Group is implementing a rapid increase in the number of brand locations in Japan's hot spring areas. The popularity of the hot spring ryokan category in Japan has deep roots. At the same time, it is also a category that is expected to gain support from the inbound market going forward. Kai is the only full-scale chain of luxury hot spring ryokans in the Hoshino Resorts Group, and it will work to reinforce that position further. The immediate target is to increase the number of Kai facilities from the current 15 locations to 30 locations nationwide. An overview of the property is shown in the table at the bottom left, and this is a relatively new structure that was completed in August 2017. There are 48 guest rooms in total, and Hoshino Resorts Group is the operator. The acquisition price was 3,060 million yen. The appraisal NOI yield is 5.8%, and the yield after depreciation is 4%. The scheme used to acquire this property is unique and is shown at the right of the page. This is a scheme to acquire properties using investor funds through joint fund setup by sponsor Hoshino Resorts and the Development Bank of Japan. Hoshino Resorts and the Development Bank of Japan have set up a jointly operated fund to support the companies operating accommodation businesses, etc. in Japan. This Kai Alps is the first property developed by the number one fund of the jointly operated fund. Currently, a number of other developments are in progress, as shown in the graphic, with the number one fund developing Rizonare Nasu, both number one and number two funds involved in developing Omo 7 Osaka Shin Imamiya, and number two alone working on development of Hoshinoya Okinawa and Kai Nagato. All of these projects are currently making satisfactory progress. Next, please look at page 8. This is the Hotel Nikko Kochi Asahi Royal. Although this hotel is located within walking distance from the Harimaya Bridge area in central Kochi, its quiet surroundings provide a tranquil setting. The facility offers a comfortable stay with excellent convenience, making it a suitable choice for both business travelers and tourists. This is a sightseeing spot which has an abundance of cultural tourism resources, such as its seafood cuisine and the Yosakoi Festival. An overview of the property is shown in the table at the bottom right. There are 191 guest rooms in total, and the lessee is outside the Hoshino Resorts Group. The type of rent is entirely fixed rents, and the operator is Okura Nikko Hotel Management Company Limited. The acquisition price was 2,200 million yen. The appraisal NOI yield is 6.5%, and the yield after depreciation is 4.2%. Next, please turn to page 9. Here we have earnings forecasts for the 13th and 14th fiscal periods. Last year, we experienced a variety of natural disasters that were outside the range of expectations. As you will realize if you look at the basis for calculating rents on page 11 of these materials, we have incorporated into our forecasts the assumption that the impact of the earthquake in northern Osaka Prefecture in June 2018, the torrential rainfall in western Japan in July, Typhoon Jebi and Hokkaido Eastern Iburi earthquake in September will appear in the 13th fiscal period for sales-linked properties. and in the 13th and 14th fiscal periods for profit-linked properties. The earnings forecasts reflect these impacts. As a result, distribution per unit for the 13th fiscal period is expected to be 13,110 yen, and to reach 13,230 yen in the 14th fiscal period. Next, please look at page 10. Now we will discuss distributions and NAV per unit. As shown in the graph on the left, distributions have increased for 11 consecutive fiscal periods since listing. However, distributions in the 12th fiscal period increased by only 1.3% over the previous fiscal period. Also, distributions are expected to grow 1% in the 13th fiscal period, and to grow 0.9% in the 14th fiscal period over the previous fiscal period. This is due to the decline in projected distributions as a result of the impact of natural disasters, etc., being offset by acquisitions funded with debt. From the 15th fiscal period onward, after the temporary factors related to natural disasters have run their course, we will seek growth in distributions of 2% per fiscal period, or 4% annually, as was previously the case. NAV per unit has also grown to about 1.8 times the size of what it was in the second fiscal period. Going forward, we will continue to strive for continued growth in distributions and NAV, improved stability, and increases in unit holder value. On the following pages 11 and 12, there is an explanation of types of rent. On this occasion, I will omit further discussion of this. Please now turn to page 14. First, allow me to present a summary of our operational results. The left side shows the year-on-year changes in the sales of properties operated by the Hoshino Resorts Group. All properties enjoyed extremely strong sales and finished the year with increased sales. While some facilities were affected by disasters, on a full-year basis, revenue was unaffected. Sales increased 4.1% year-on-year. I believe this again proves the stability of the revenue of properties operated by the Hoshino Resorts Group. The right shows the sales of properties operated by those other than the Hoshino Resorts Group. I believe that the 4 ANA Crown Plaza properties managed to perform strongly. However, the Hyatt Regency Osaka experienced reduced sales due to significant effects from natural disasters. In total, sales of properties operated by those other than the Hoshino Resorts Group fell 1.4% year-on-year. Page 15 begins my explanation of the operational results for each property. At the top of page 15, we can see that Hoshinoya Karuizawa remains strong. This is the result of long-standing efforts to create the attractiveness of the Hoshino area, and the number of weekday guests is increasing. Next is Hoshinoya Kyoto. This property was affected by the torrential rainfall in western Japan last July and the typhoon last September. It was also then closed for 14 days this February for planned renovation work. As a result, sales fell slightly year-on-year, but the KPI remained strong. The next properties are Rizonare Yatsugatake and Rizonare Atami. The 2 Rizonare properties are performing extremely well. To review the Rizonare brand, we are not aiming to simply be a Western-style resort hotel, but to be the #1 brand catering to trips with children and families, consistently a large segment in the travel market. In Japan, special needs are created from guests with children 12 and under, changing travel patterns. By responding to these needs by targeting commercial areas with significant market scale, both facilities continued to produce strong results. Next, in the middle of page 16 are the 6 Kai properties. Including the properties in the premium fixed rent period, we now own 9 properties in the Kai brand. Kai brand facilities have relatively few guest rooms, around 50 per facility at most. By increasing the number of facilities with few guest rooms, we are able to diversify the risk of temporary fluctuations caused by natural disasters, such as volcanic activity. While some have suggested that operating small-scale facilities is inefficient, we have completely resolved this issue through the unique management methods of the Hoshino Resorts Group, maintaining high profitability. Next, at the bottom of page 16 is Hyatt Regency Osaka. Due to the natural disasters last year and the new large-scale supply within Osaka City, sales fell largely year-on-year, except for the general banquet hall. However, compared to the hotels near USJ, the year-on-year decline was gradual, and the accommodation business put up a good fight. Amid increasing interest in the area with the decision to host the World Expo 2025 in Osaka, starting this spring, we reshuffled important organizational posts and worked to strengthen our organizational structure. Additionally, we implemented even more meticulous marketing, sales policies, and cost control than in the past, as we worked to recover performance. Please now turn to page 17. Page 17 shows the results for the 4 ANA Crowne Plaza properties. Sales for ANA Crowne Plaza Hiroshima fell slightly due to disasters. However, ANA Crowne Plaza Fukuoka maintained stable sales due to an extremely strong market. Sales for ANA Crowne Plaza Kanazawa fell slightly due to the new supply of 1,500 rooms within Kanazawa City. Sales for ANA Crowne Plaza Toyama rose year-on-year, excluding wedding demand. We feel we have built a position as the #1 hotel in the region and that operations are stable. All 4 properties did their best to make it through the year. Next, second from the top on page 18, are the 22 Solare properties. Portfolio diversification has been effective for these 22 properties, and earnings are expected to remain strong. Next are the 4 The Bee properties. Supply of hotels that specialize in accommodation is increasing throughout Japan. While the Bee properties are being affected by this increase, we were able to produce results by focusing on inbound demand. The very bottom of the page shows the results for Hotel and Rooms Osaka Honmachi. The Osaka area continues to experience excess supply. We are seeing a decline in the ADR and occupancy rate for the entire Osaka area. This property is being similarly affected by the market, but we believe it will remain stable in the medium term, as it is strong in capturing inbound demand, with an expected increase in the number of days stayed. We are evaluating policies aimed at capturing inbound demand. Next, please turn to page 20. Page 20 shows our future management policy. While this was also mentioned in the presentation materials for the previous financial closing, by further accelerating the cycle of increasingly robust competitiveness, which is our mutually beneficial model with the Hoshino Resorts Group, Hoshino Resorts REIT is aiming for further sustainable growth. One main reason always present in selecting hotels is newness and cleanness. Given a life cycle of decades, competing hotels newer than our hotels are sure to be built, and we follow the important management principle of not competing against latecomers on the basis of the newness of facilities. In a model of competition based on equipment and facilities, latecomers can win out. Therefore, we must create a structure in which the older established hotels have competitive advantage by competing based on know-how and experience. The Hoshino Resort Group's approach resolves this issue through 3 types of know-how and experience born from the long-standing local business. The first is a system that continuously creates and advertises the attractiveness of our properties. By creating reasons to stay at the hotels even in the off-season, the group eliminates seasonality. The group sees the locations and facilities of the hotels as its stage, and the anticipation of what will be performed on that stage as its attractiveness. The second type is a flat organizational culture that increases the creativity of the hotel management teams. The group sees the individual staff members who care for guests and provide services as creators who create the new types of attractiveness. The attractiveness of each facility is born from its flat organizational culture. The third type of know-how and experience is born from sustainable synergies to attract guests arising from deep relationships with the region. The group works with an awareness that the hotel and region are inseparable. The hotels act to advertise the attractiveness of the region, which contributes to building the regional brand. In the activities based on this relationship of trust with the region, it is the older established hotels that have the advantage, and we are able to maintain this advantage on a sustainable basis. Hoshino Resorts REIT believes that making full use of the three forms of know-how and experience of the Hoshino Resorts Group will contribute to revenues. Now please turn to page 21. In terms of external growth, we want to further expand asset size by acquiring hotels and ryokans that serve as a core for tourism in each region, mostly through the sponsor's extensive pipeline, and achieve a continual improvement in unit holder value. We will continue working towards our target asset size of 200 billion yen, while focusing in particular on improving the portfolio quality. Our initial target was 200 billion yen by 2020, but we may reach this target a little later than that. As the pie chart on the upper right shows, Hoshino Resorts brand facilities currently comprises 32% of our assets, but we are looking to increase this to 50% by the time we reach the 200 billion yen mark. Next, please look at page 22. This page shows a sponsor pipeline list. Facilities owned by the Hoshino Resorts Group are on the left. Hotel Nirakanai Kohamajima is the most recent addition. The 9 properties, excluding the Surfjack Hotel and Swim Club in Hawaii, would total about 40 billion yen, assuming we acquire them at our acquisition benchmark, which is a yield after depreciation of 4%. The middle row shows facilities owned by third parties. We will very likely acquire some of these properties, such as BEB 5 Karuizawa, but we have no estimates for acquisition amounts. The list on the top right shows projects being developed by the joint fund between Hoshino Resorts and the Development Bank of Japan. There are currently 4 properties, and based on the size of the development projects, we think that they will exceed 50 billion yen in total. I will discuss each of them in a moment. The list under that shows the facilities under development. Just the other day, the sponsor issued a press release stating that construction of Hoshino Resorts Kai Beppu commenced on June 14th, and that it was aiming to launch operations in the spring of 2021. The property is being designed by famous architect Kengo Kuma. The 4th facility from the bottom, located in Shimonoseki City, Yamaguchi Prefecture, has been given the provisional name Hoshino Resorts Omo Shimonoseki. Aiming for operations to start in 2023, Hoshino Resorts and Shimonoseki City have announced that they will work together to open a fantastic hotel that makes full use of its view of the Kammon Straits. Next, please turn to page 23. I'd like to briefly discuss the 4 properties being developed by the joint fund with the Development Bank of Japan. I'll start with Hoshinoya Okinawa. This property, scheduled to open in the spring of 2020, is Hoshino Resorts Group's first property on Okinawa Island and aims to be the best luxury resort in Okinawa. There will be 100 guest rooms, and the high nightly rates reflect the focus on luxury. Rizonare Nasu is scheduled to open in the autumn of 2019. It is Japan's first resort hotel based on the agriturismo concept. This hotel has 43 guest rooms and is a very attractive property. Now please look at page 24. Kai Nagato is scheduled to open in March 2020. With this property, Hoshino Resorts has designed a master plan for the entire hot springs town and aims to realize the plan together with the local government, other hot spring ryokans, and local businesses. This activity will create new value for the region and will revitalize the entire hot springs town. Kai Nagato will be a central presence in the town, allowing it to remain in a leading position. Please look at the bottom part of the page. Omo 7 Osaka Shin Imamiya is scheduled to open in April 2022. This is an urban tourism hotel under the Omo brand, aiming to add excitement to people's stays in Osaka. It will be a relatively large hotel, with 14 above-ground floors and 436 guest rooms. The Omo brand concept is to build hotels in areas with deep local flavor and use hotel marketing to raise the area's value and create lodging demand, rather than simply building hotels in areas that already have high lodging value. Moving ahead, page 25 shows a portfolio map of facilities that are operated or planned to be operated by the Hoshino Resorts Group. I will not discuss them here. Next, please look at page 26. To realize internal growth, we have been strategically and continually making attractiveness-enhancing capital expenditures. The investment has culminated in favorable outcomes, as shown in the graphs at the bottom. Page 27 shows our most recent initiatives. I think our attractiveness-enhancing capital expenditures have yielded good results because they have been in line with market needs. This page shows two examples of recent capital expenditures. We renovated guest rooms to respond to the needs of three-generation families, and at Kai Ito, we carried out full-scale renovations. We expect these initiatives to lead to upside at both properties. Moving ahead to page 28, I would now like to discuss our financial strategies. Our aim is to build a more stable financial base by reducing loan costs and shifting to long-term fixed interest rates. The graph on the top left shows average interest rates, average remaining periods, and average loan terms. As the yellow bars show, we have been lengthening our loan terms for new borrowings lately. The fixed interest ratio graph on the top right shows that the fixed interest ratio is currently 95.9% and has remained high despite the increase in the balance of interest-bearing liabilities. Concerning financial repayment dates as shown on the bottom left, we have reduced refinancing risk by spreading out repayment dates and establishing the first-ever hotel J-REIT commitment line. The green part of the bars shows the borrowings until the third public offering, which are coming up for refinancing. As the list on the right shows, we had been borrowing at relatively high interest rates. Therefore, the improvement in the interest payments based on future refinancing should provide upside, particularly from the 15th fiscal period onward. Next, please turn to page 29. We will continue to control LTV in the 30 to 40% range. At the end of October 2019, we expect acquisition reserves of 12.5 billion yen, up to an LTV of 40%, as we continue to strike a balance between financial stability and property acquisition agility. Now please look at page 30, as I will briefly explain our ESG initiatives. With respect to the environment, Hoshinoya Karuizawa pursues coexistence with nature with an in-house power generation system, which makes the facility about 68% energy self-sufficient. Please look at the page for more details. Page 31 also discusses an environmental initiative. Hoshino Resorts Group has decided that during 2019, all accommodation facilities that it operates will stop using individually packaged soaps, replacing them with pump-action refill bottles. This switch will result in a roughly 49-ton reduction in plastic container waste. An initiative by Hoshino Akuto is explained on the bottom of the page. Page 32 explains a social initiative by Hoshinoya Taketomi Island. Please take a look at this when you have time. Now please turn to page 33. This spring we completely renewed our website. It is now easier to find the data you are looking for. In addition, information about Hoshino Resorts, the tourism market, and other information is shown on the home page. Please make sure to have a look. In closing, I would like for you to look back at page 1. Page 1 gives a review of Hoshino Resorts REIT's basic philosophy since going public. We aim to create schemes to benefit from the growth in Japan's tourism industry through unit holders owning investment units, and continually expand unit holder value. We will continue to invest in line with this basic philosophy, and we look forward to your continued support. Thank you for listening.